Hi, and welcome to the Market View for Thursday, the 31st of July 2014. And starting off with the 30-minute chart, we can see that yesterday we had a bit of movement, a total range yesterday of 61 pips. So things improving slightly on the volatility front. Let's hope things continue to improve. And yesterday I was talking to one of the support team about how narrow the trading range of the markets currently are. And we were reflecting upon, between 2008 all the way up to around 2000 and beginning of 2013 or a little later than that we used to average 150 pip move per day for just the pound alone. And this seems to have disappeared of late. But all things being equal, we will start to see some sort of resumption of this sort of volatility. Certainly an improvement in the last couple of days. No signals for the downside. That's because the volatility isn't great enough to present any signals, apart from when we had the announcement from Yellen yesterday evening at 7 p.m. You can see there was a buy signal, which was just reversing the market off the earlier down move, and then going into a sideways range there. This is also shown in the daily chart there. You can see prices trading down to the 169 level. That's about the 169 level there, and prices finding support there. So again, we're through the two lines that we drew on before, so let's just mark up from the left there. You see we're just finding support there at 169.17, so the market hopefully we'll find some support at this area. Again, we can see the continuation of the down days, just one slightly green bar in between here, but the rest of the days it's just been a slow grind to the downside there. So not an awful lot there. Just watch out for support in this area, as we can see the buying coming into the market on the left hand side here. And let's see if prices do start to trade more or less sideways to higher, even if it's just for a few days before resuming the downtrend. And in the news, what have we got today? Let's have a look. Nationwide house price index is supposed to be out at 7 a.m. It's already... no, it won't be out yet. It's 6:30, so half an hour's time we've got the nationwide house price index, which is to show a slight reduction in house price rises there. CPI flash estimate at 10 a.m. Unemployment claims for the US, that's the weekly one at 1:30, and that's about it for today as far as the news is concerned. On the Dow front, yesterday the market... moving higher initially on the better than forecast GDP figures. I don't know whether you saw this yesterday. GDP advanced figures coming out at 4%. Absolute joke. And like I said in yesterday's market view, the governments now are using any sort of revenue generating criteria to try and pump up the GDP figures to make it look as if the economy is recovering, and there's no chance of it recovering. And I'll go on to prove this point by just going to the Economist Debt Clock, which you can find just by typing in Economist Debt Clock, and it gives you the global debt for each country, and as a percentage of GDP. You can also change it to whatever you want as well, but the US is currently sitting at 84% of GDP. Debt as GDP. So it's just a nonsense. These sort of GDP figures of 4%. You're not going to clear 84% worth of debt. 13 trillion in debt. And actually, incidentally, the UK, where everybody thinks the UK is fine, it's 97% of GDP, debt to GDP as well, at 2.5 trillion. It's closer actually with unfunded liabilities to 4 trillion. And the US 16 trillion as well. It's actually 21 trillion for the US with unfunded liabilities, i.e. pensions and so on. But again, these make these figures look quite small against Japan at 243% of debt to GDP. So there is no way we are going to see any sort of recovery. We have a debt-based economy where they print money, send it out as through the primary banks, which is then lent as credit, which people borrow and ends up as basically paying interest on fresh air. And this is how it's been for the last 40 odd years, and until it changes, then you will not see a recovery, which is why we've always had boom and bust. Print the credit, get the boom, turn the credit off, you get the bust. Until we've reached the point now where the interest payment on the debt is not inconsiderable, such as the UK, 200 million, that's right, 200 million per day. So when you see these sort of figures, Cinderella Land, or Alice in Wonderland I should say, then no surprise really that the market sort of rejected it yesterday. So going back to the chart, you can see the market trading down just below the 76% retracement. So you see the market there just finding support at 16,860 level there. On the implied volatility front, this moved up slightly yesterday to 1061 because obviously the market oscillated between euphoria and then decided to move lower before coming off the lows. And the historic volatility at 715, and again you can see the small increase in the price chart there. So let's see what today brings. All things being equal, I will see you in tomorrow's market view. Have a great day. As ever, thank you for your support. And as ever, thanks for watching.